There is a question that almost nobody asks out loud, but almost everyone thinks about. Where do wealthy people actually keep their money? Not the abstract answer, the real one. The specific places where someone with genuine financial sophistication parks their cash, grows their wealth, and protects what they have built. Because here is what most people assume. They assume wealthy people have some secret access to exclusive investments that regular people cannot reach. Private deals, members-only funds, opportunities that require a minimum investment most people will never have. Some of that exists, but it is not the main story. The main story is simpler and more useful than that, because the three places where financially sophisticated people keep the majority of their money are accessible to almost anyone. They are not secret, they are not complicated, but they are dramatically different from where the average American keeps their savings. And the average American keeps their savings in one place, a savings account, maybe a high-yield savings account if they've been paying attention recently. And that choice, while understandable, is costing them compounding returns every single year. I am going to show you exactly where that money goes instead, why those places work better over time, and how to start moving your own money in the same direction.
Place 1. Tax-advantaged retirement accounts. The first place is not glamorous. It does not require special access or a minimum investment that most people cannot meet. But it is the single most powerful wealth-building tool available to working Americans, and the majority of people are not using it to its full potential. Tax-advantaged retirement accounts, specifically the 401k and the Roth IRA. Here is why sophisticated investors prioritize these above almost everything else. Every dollar inside a traditional 401k grows without being taxed annually. Every dollar inside a Roth IRA grows without ever being taxed, not when it enters, not while it grows, not when it comes out in retirement. The tax treatment alone, over decades of compounding, creates an enormous advantage over a taxable savings or investment account. Consider the math. A dollar invested in a taxable account at 7% annual return for someone in the 22% tax bracket effectively grows at a lower rate because a portion of the return is taken by taxes each year. A dollar inside a Roth IRA grows at the full 7% with no annual tax drag whatsoever.
Over 30 years, that difference produces a dramatically different outcome on identical starting capital. The Roth IRA dollar wins, not because it was invested in anything different, but purely because of the tax structure surrounding it. Financially sophisticated people understand this, and they max out these accounts before putting money anywhere else. In 2024, you can contribute up to $23,000 annually to a 401k and up to $7,000 to a Roth IRA. Together, that is $30,000 per year that can grow completely shielded from annual taxation. The second layer of this is the employer match. If your employer matches 401k contributions up to a certain percentage of your salary and you are not contributing enough to capture that full match, you are leaving free money on the table. The employer match is a guaranteed 100% return on those dollars before the market does any.
Place 2. Broad market index funds in a taxable brokerage account. Once the tax-advantaged accounts are maxed, the second place where sophisticated investors direct their money is a taxable brokerage account invested primarily in broad market index funds. This is where the wealth building that goes beyond retirement accounts happens, and it is accessible to anyone with a brokerage account at Vanguard, Fidelity, Schwab, or similar platforms, accounts that are free to open and carry minimal fees. The index fund is one of the most important financial innovations of the 20th century. Before index funds, investing in the stock market meant either picking individual stocks, which requires significant knowledge and time, and which most professional managers cannot consistently do better than the market, or paying a fund manager to do it for you at a cost that significantly erodes returns over time. The index fund eliminates both problems. It tracks a broad index, typically the S&P 500 or a total market fund, which means it owns a small piece of every major company in America. It requires no active management decisions, and it charges almost nothing in fees. Vanguard's S&P 500 index fund charges 0.03% annually. On $100,000, that is $30 per year. The math on index funds over long periods is extraordinary.
The S&P 500 has returned an average of approximately 10% annually over the past century. After inflation, the real return is approximately 7%. After the minimal fees of an index fund, the return is nearly identical. No active manager, no hedge fund, no sophisticated stock picking strategy has consistently beaten this over any 20-year period on a fee-adjusted basis. Financially sophisticated people understand this. They are not constantly trading. They are not watching financial news and reacting. They are not in speculative positions in individual companies. They own the entire market through low-cost index funds, and they let time and compounding do the work. The taxable brokerage account also has a tax advantage that most people do not think about. Long-term capital gains on investments held longer than 1 year, are taxed at a lower rate than ordinary income. For most Americans, the long-term capital gains rate is 15%. The ordinary income tax rate for the same person might be 22 or 24%. Simply by holding investments for more than 1 year, you receive a lower tax rate on the gains. Combined with the ability to harvest losses in years when the market declines, selling positions at a loss to offset gains elsewhere, a taxable brokerage account managed with basic tax awareness can produce significantly better after-tax returns than most people assume.
Place 3. Real assets with cash flow. The third place is where the conversation becomes more interesting and where the gap between sophisticated investors and average savers becomes most visible. Real assets that generate cash flow. For many high net worth individuals, this means real estate, specifically income-producing real estate, rental properties, multifamily units, commercial properties that generate monthly cash flow from tenants while also appreciating in value over time. The power of income-producing real estate comes from several simultaneous advantages that most other assets do not offer. Leverage allows you to control a large asset with a relatively small down payment. A 20% down payment on a $400,000 property gives you control of the full $400,000 asset. If that property appreciates at 3% annually, the return on your actual invested capital, the $80,000 down payment, is significantly higher than 3%. Cash flow from tenants effectively has your investment paying for itself over time. If a property generates positive cash flow, rent collected minus all expenses including the mortgage, it is adding to your wealth every month while simultaneously building equity through mortgage paydown and appreciation. The tax treatment of real estate is exceptionally favorable.
Depreciation, the IRS allowance to deduct the cost of the property structure over 27.5 years, can offset rental income and create a paper loss, even when the property is cash flow positive. This is one of the primary reasons real estate has historically been a wealth-building vehicle for people across income levels. Not everyone has the capital or the appetite for direct property ownership. For those who want real estate exposure without landlord responsibilities, real estate investment trusts, REITs, offer ownership in diversified real estate portfolios that trade on public markets, like stocks. REITs are required by law to distribute at least 90% of their taxable income to shareholders, which creates consistent dividend income. Beyond real estate, some sophisticated investors hold other real assets, commodities, inflation-protected bonds, or stakes in private businesses that generate income. The common thread is not the specific asset class. It is the focus on assets that produce cash flow and hold or grow their value relative to inflation, rather than assets that simply hold value without generating returns.
How to apply this to your situation? Let me give you a concrete sequence for applying this framework regardless of where you are starting. Step 1. Build and maintain your emergency fund in a high-yield savings account. 3 to 6 months of essential living expenses. This stays liquid and accessible. Do not invest this money. It is not an investment, it is insurance. Step 2. Capture every dollar of your employer 401k match. This is the highest guaranteed return available to anyone. Do this before anything else. If your employer matches 50 cents per dollar up to 6% of your salary, contribute at least 6%. Step 3. Max your Roth IRA if you are eligible. $7,000 per year. If you are not eligible due to income,
Look into the backdoor Roth strategy with a tax advisor. Inside the Roth, invest in a total market or S&P 500 index fund. Step 4. Return to your 401k and increase contributions toward the $23,000 annual maximum. Inside the 401k, invest in the lowest cost index fund options available in your plan. Step 5. Once tax-advantaged accounts are maxed, open a taxable brokerage account. Continue investing in broad market index funds. Hold investments for more than 1 year to qualify for preferential capital gains tax rates. Step 6. As capital accumulates and income grows, evaluate real assets, particularly income-producing real estate, as a third leg of the wealth-building strategy. This step requires more capital and more knowledge, but the principles are learnable and the benefits are significant for those who pursue it deliberately.